Hey everyone. So, over the next three videos, I want to help guide you through understanding and leveraging delta in trading. And this series is meant to help you select the right contracts for a higher probability of winning trades. Okay, so here's the plan. The plan is that we're going to do an intro to delta, which will be this video, and we're going to cover what it is and why it matters. And the next video is going to be about finding the expected move and help using the delta to help us predict the stock movement. And then the third video is going to be about choosing the best contract. So making sure that we maximize our odds of success for winning in options. And you may not be trading options, but this will definitely be more beneficial for anybody trading stocks as well too. So making sure that you understand how delta works is going to be very beneficial for your trading. Okay, so let's dive into the delta. And let's start off with what delta measures, okay? So delta measures how the price of an option changes to the price of the stock movement. Think of it like your first mate on a ship. It keeps you informed about how much your treasure, which is the option, is affected by the tide, so the stock price. And so delta, which we're looking here at my brokerage for Webull, is on this right column. We're actually going to put the both sections right here. Let me see if I can make this a little bit bigger for you guys. Okay, so right here, the delta is for the puts. The delta left on the left-hand side is for the calls. Delta ranges from -1 to 1. Okay, so for the call side, I'm just going to put this screen up here. It ranges between 0 to 1. And so the closer it gets to 1, that means the deeper in the money the contract is. And for puts, it ranges from 0, right? You can see here 0 delta is getting all the way to -1, okay? -1. And so -1 doesn't mean that it's bad. It just means that the closer it gets to -1 for puts, the deeper in the money that contract is going to get. And a higher delta means that the option is the all that means is that the higher the delta, the higher the probability that that strike is going to stay in the money. And the lower the delta is, the lower the probability. Okay. All right, let's switch it back to here, to this view. And so understanding delta in action is extremely important. Okay, so remember that an option represents 100 shares of a stock. So for instance, if you buy a call, let's say a call with 56 delta, right, the 608, 0-day expiration, the price of the contract is going to increase by $56 for every dollar increase of the stock price. So that means that if you get a 608 contract with 57 delta and SPY moves another dollar, then your contract is going to increase by $56 or 57, whatever the value is here. Okay. But what you have to understand as you're looking at this screen at this option chain is that delta is not a constant. It's not static. It's affected by time. It's affected by gamma. It's affected by implied volatility and theta. And as you approach the expiration, like for example, 0 DT or anything less than like weeks, as time gets closer, delta becomes more sensitive to price changes, especially for short-term options, okay? So for example, short-term options like today require a significant stock price movement to become profitable. For example, if you take into consideration this 611 contract, it has a delta of 0.03, okay? So that means for this stock to become profitable and have a higher probability of winning, the price of the stock as of right now, because we're almost near half the day of today for this expiration, it needs to move very, very strong to become profitable. And that's because you have theta working against you. Theta by default is designed to destroy these contracts. Okay. It's designed to destroy out of the money contracts. You can see here we have a 0.02 something, and the ask price for this 611 is 0.03. As time gets closer, this theta is going to increase even more to destroy these contracts to zero, to make them worthless. So it's really important to know that when you're picking out of the money contracts, it's very risky, okay? Now, if we go to something that's like a longer time frame, for example, let's say like 30 days out, you can see here that theta or delta remains high even out of the money, right? It can remain out of the money or maybe in the money, but it remains high. And that's because theta is a lot lower. And that's all because you have time. Time is your insurance for options. So don't, if you want to pick something that is safe but and profitable and that has a high probability of winning, always give yourself time. Okay, time is a very, very underutilized utility when it comes to trading options. Now, what does this mean for like a stock trader? Well, all this means is that if you're looking at today and you're looking at delta, you could just say like, okay, what's the probability of us getting to 611 today? If it's not anything between 0.25 and 50 delta, consider that a low probability. Okay, so as of today. Okay, so again, why does this all matter? If you select an option contract with short expiration, the stock price has to move dramatically in your favor to just even break maybe even. And then again, understanding this concept will help you avoid picking options that have expiry worthless, like that can expire worthless. So don't pick contracts that are 0.25 or lower. Okay, always pick something that's higher. I personally like the 0.38. I think that's a good probability of getting in the money as soon as possible. And yeah, I think that's the intro for this video for now. I think it's a pretty good explanation of how delta works, why it matters. I don't want to go too much in depth on how to calculate expected moves. I'm going to do that in the next video where we'll explore how to calculate the expected move using the delta. And hopefully this will give you insights into potential price targets, whether you're trading options or just the stock itself. All right, cool. I'll see you guys on the next one.